Appraisals. Let's talk about this chapter. This is chapter 16. Okay, let's get this started. So, at the end of this chapter, you'll be able to describe the differences among the various types of value, also explain the three approaches to value that are considered in an appraisal. And you're also going to be able to kind of briefly discuss the practice of appraising. Okay. The practice of appraising is different from buying and selling real estate. Okay, so when you get your real estate license, you are not a licensed appraiser. So let's talk about what is an appraisal. Okay, so what is an appraisal? It's an estimate or an opinion of value. Now, that opinion is based on supporting evidence, okay, and approved methods. So we're going to talk about all three of the methods. Now, it has to be done by an appraiser who is licensed, okay? And here's what we're going to talk about a little bit with an appraiser. An appraiser there's several different types of appraisers. Now, as far as diving into the minutia of the different appraisal licenses, I'm not going to really do that. Your book goes into it in a little bit of detail, so that should be enough for you to really kind of be able to pass the exam, pass the test that they're going to ask you, pass the questions that they're going to ask you. But as far as an appraiser is concerned, what you have to understand is that an appraiser not only has to take classes, but they also have to do an apprenticeship, okay? An apprenticeship under a licensed appraiser, and they have to do a certain number of hours depending on what license they are going for, okay? Depending on what license they are going for. And they are also trained to provide an unbiased estimate of the value. So they are going to be giving an opinion of the value of the real estate, okay, based on supporting evidence with approved methods. Okay, they are licensed, they are an independent individual, and their opinion should be unbiased. Okay, now as a real estate salesperson or broker, you cannot advertise a free appraisal, even though one of the approaches to value that we will look at is going to be similar to that of an appraisal. It is not an appraisal. You can never advertise that any service that you do is an appraisal unless you are a licensed appraiser. Okay. So let's talk about the times that we would actually be using an appraisal. So estates require appraisals all the time. Divorce proceedings, if you're financing, okay, as far as refinancing, taking out a mortgage, things of that nature, okay? Taxation, relocation. Relocation companies sometimes ask for an appraisal. Condemnation. So we know that condemnation is the process in which the state takes back or the government takes back a property through eminent domain. So condemnation, they have to give fair market value. Insurance, damage, loss, and feasibility are also other situations that would potentially require an appraisal. Okay? Now, they're going to give you 5 attributes to land. So we have to kind of talk a little bit about real estate and why it is valuable, okay? Because that's something that we're going to discuss. We're going to discuss the market, conditions that affect value, and why real estate is valuable. So first, it's finite in its supply. It's finite, okay? Also, real estate is physically immobile. Because it is physically immobile, it has its own unique location and characteristics. Real estate is durable for the most part, and it is useful to people, okay? The real estate is what offers us land, shelter, provides us with an economic situation where we could potentially work, where we could raise crops, things like that. It is useful to people. And here's the thing about real estate. This is really something that you have to take to heart, is it's unique. Each property is unique and has its own characteristics. So no two properties are ever going to be exactly the same because there are intangible assets such as views, location, location in regards to potentially another a prime location, a desirable area. Okay, even if you're one house over, that could affect value. You could be extremely similar, and we'll talk about the principle of substitution. You could be very similar, but not exactly the same. Okay. Now, basic principles of value. To get the highest value for your property, you must have its most profitable use, okay? And also, it has to have some sort of substitution principle. Let me talk a little bit about the substitution principle. Substitution is basically saying that if there are two homes that are similar, the least expensive of the two will sell first. Okay, this is how we compare things. This is how we kind of use one of the approaches to value, which is the sales comparison approach. So substitution, if two properties are similar, because again, we have said that there is no two exact properties. If two properties are similar, right, then what happens is the one that is priced less than the other one will sell first. That's the principle of substitution. When you could substitute one property for another, okay, the least expensive of the two will sell first, okay? So let's talk about the three comparisons, the three approaches to value. The actual appraisal process is what we're talking about right now. Now, first, what we have to do is we have to say that the sales comparison approach is best used for residential properties. Okay, so this is the property type that you will be using for this. Now, residential properties, when they are appraised, what they do is they compare the subject property. When we're saying subject property, that's the property that we're trying to find the value of. And then what we do is we find similar properties called the comparables that have sold, okay? And we make adjustments to the comparables based on the date of sale, location, physical features, terms, and conditions of the sale, okay? Now, there's two things that you should know, which is CBS and CPA. CBS is comparable is better, you subtract. CPA, comparable poorer, you add. What are we talking about in regards to that? Okay, so let's say my subject property is a 3-bedroom, 2-bath home, right? So it's a 3-bed, 2-bath home, okay, in Freehold, New Jersey. Now, a property sold, okay, in Freehold about a month ago. It is similar to the subject property. So this is a comparable that is sold that is similar to the subject property. It is a 3-bed, 1-bath. So what happens is this. The comparable is poorer. So the assumption that the appraiser is going to make is saying, okay, that sold for $200,000. That comparable, okay, that has one less bath. The subject has one more bath. What is the addition that we have to make to account for what the subject property could potentially sell for, okay? What could it potentially sell for? Now, appraisers do not have, when they're using the sales comparison approach, they don't have any kind of guide that they go off of, like, oh, a bedroom is going to cost this much and a bathroom is going to go off this much. What happens is this is an opinion. So based on their knowledge of the area, based on their real estate appraising experience, what is their opinion of how much a bathroom might be? And that might be $5,000. So they might say that a home with one extra bathroom would probably sell for $5,000 more. So what happens is the adjusted value of that home would be $205,000 if we were taking a look at it that way. So $205,000 is the adjusted price, even though it's sold for $200,000. And what they'll do is they'll take all the comparables, adjust just like that. Okay, if it's better. Okay, so let's say it was the adverse. Okay, and the comparable was better. So let's say the comparable had the extra bathroom. You would be subtracting that $5,000 that the appraiser said is what they would account for a bathroom, and it would be a $195 adjusted value. Okay, so and there are other things that they adjust for, plus or minus, depending on what it is. Now, the next type of um, approach to value is going to be called the cost approach. The cost approach is used usually for public buildings. Okay, so school, police station. This is usually when you have to find out the value of the real estate for insurance purposes. So here's what they do: they estimate the value of the land, then they estimate the current cost to construct the same building. They estimate accrued depreciation, deduct that accrued depreciation from the estimated cost of the new building, and then they add the estimated land to it. So it's basically this whole big math equation. You don't have to worry about what the minutia is. You really just need to know this. So what happens is they estimate land, estimate building, then subtract depreciation, and then add what's left. Okay. Now, there's two things when they're coming up with the cost of the building, okay? When they're coming up with construction costs, there's two types that they could use. There's reproduction cost, which is an exact duplicate of the subject building at today's cost, okay? Then there's replacement cost. So just keep in mind this: if we are reproducing something, it is a replica of it. If we are replacing it, okay, we are constructing something that is new that serves the same purpose, same function as the original. Why would we do a replacement over a reproduction? Because sometimes you simply can't reproduce it the way that it was an exact duplicate. I'll give you a perfect example. There's buildings that were built at the turn of the century that used asbestos. Asbestos is illegal. Asbestos was an awesome insulator. We talk about that in one of the chapters. It was an awesome insulator. But you can't use asbestos in buildings anymore. It's illegal. So obviously we cannot do a reproduction, which is an exact duplicate of that subject building. But we can do a replacement, which is replacing it with new building materials that fits the same purpose, used for the same thing, but not an exact replica. Okay. Ooh, I went too fast on that one. Let's go back. Okay. Now, when they're going to talk about depreciation and any kind of deterioration or obsolescence, let's talk a little bit about deterioration and obsolescence, okay? The first thing is going to be curable, incurable, okay? So physical deterioration that is curable basically means that it's financially sound to fix the deterioration. If the value isn't there to do that, it would be incurable. If it is not economically sound to do that, it would be what is called an incurable physical deterioration. Functional obsolescence. What is functional obsolescence? A home that has 3 beds, 1 bath now would be considered functional obsolescence, which means that basically built today, that might not be the way that they would build homes, because a home with 3 bedrooms probably would have more than 1 full bath built in 2018. But again, this is something that functional obsolescence is just that, where it is functionally obsolete, okay? Functional obsolescence could be cured, okay? Because it could make sense to build another bathroom in it. It's not always potentially incurable. Then there is external obsolescence, and these are all things that add to the depreciation on a building, okay? External obsolescence. So let me tell you something that would be externally obsolete. If, let's say, my home was built in the 1970s, and in the 1970s in my area, this was all farmland. Now in 2018, let's say they built a racetrack down the road from me. Well, if the racetrack adds some noise, traffic, and things of that nature, that is considered external obsolescence. Okay, this is something that is making the property obsolete in comparison to when it was originally built, but it is external. It's an externality versus something that you could cure. External obsolescence is usually incurable. It's usually not something that you could fix, but it does have a depreciation on the property, okay? When there are dumps built, okay? They're experiencing that in Howell right now. There's an area where they're looking to build dumps, and it is not something that is going to be well received. Also, it's not something they can really do much about, except go to city council meetings, town hall meetings, and express their concerns to their elected officials. So external obsolescence, that adds to depreciation, okay? Because obviously, if a home was built, there are no dumps, and now there is dumps there. That would affect market value. That would affect the depreciation on it, okay? And again, the cost approach is going to be used for properties that do not have comparable sales, okay? If you don't have a sales comparable, the the property will not be used on the cost approach base. It will be used on the cost approach basis, if there are no comparables, because the sales comparison approach would not be appropriate. So this is used for public buildings such as police station, municipal buildings, etc., etc. The last one is called the income approach to value. So what is this used for? This is used for apartment buildings, office buildings, shopping centers, things of that nature. So what does it do? It takes your gross rent multiplier, okay? The gross rent multiplier, or even the gross income multiplier, are two numbers that represent a correlation between the value and the rent of similar sold properties. So you would take a property, okay, an income producing property, and you would say, okay, here is the income on that, here is the value. And what happens is you do a little division and you get a numeric representation, which would be the gross rent multiplier, okay? And here's how you use that. The gross rent multiplier is multiplied by your estimated income. So if you estimate what your income is going to be, or your known income if you know what you're going to be renting the properties out at, and you could get and extrapolate a value out of that. Now, the division problem is in your book. It's a simple, easy, this over that. You don't need to really know that. Just understand that gross rent multiplier, gross income multipliers are a numeric representation of the relationship between the income and the value of a known property that is sold, okay? Because some strip malls are not alike, but here's the thing. What a strip mall would rent for in, let's say, Freehold Township is going to be similar to what a strip mall would rent for in, let's say, another part of Freehold Township, okay? So there is a relationship there, and what you're doing is you're taking the known value of that property, if it is sold, okay? And then what you're doing is you're taking that relationship between the two numbers, the value and the income, and you are using that number, that numeric representation, to find yours. Because let's say that strip mall that sold was a 25 store, right? 25 store strip mall. Let's say your strip mall that you're building, okay, or that you're looking to purchase is a 3-store strip mall. Well, they're going to be vastly different. So the sales comparison approach would not be wise to use. However, would we not say that if the stores are the same, size, that there would be a relationship between the value and the income? Yeah, definitely. So that's what the income approach is. Now, we've talked about our 3 approaches, the properties that we would best use them for, okay? Sales comparison approach, which will be used for residential properties. The cost approach, which will be used for public buildings, buildings that don't have any income produced or any sales, okay? Then we have the third approach, which is your income approach, which is used for income producing properties. Now, what the appraiser will do at the end of everything is what's called reconciliation. They will pick one or multiple approaches to value that make sense for them, okay, to use, and they will explain why they did or did not use the other approaches to value, okay? And they will reconcile the data that they have found and come up with one value for the property, one market value for that property, okay? And that is appraisals. That's it. That's all she wrote. Again, if you have any questions or concerns, feel free to reach out to me. Have a good one.